Another thing that's important to address is calculating proper risk versus reward objectives. We always want the risk versus reward to be skewed in our favor. So in the off chance that we're wrong, we're willing to lose a certain amount, that's okay. But if and when we're right, we want that reward to be exponentially greater than the risk that we're taking. Follow me, I want to show you an example. Here we're looking at a stock with very clear resistance right around $96 per share. We have a prior uptrend in place. We can call this maybe a symmetrical triangle, an ascending triangle of sorts. Regardless, we have clear overhead supply around 96. Coming into this consolidation, we know we're in a prior uptrend that should resolve in the direction of the underlying trend. Sure enough, the market breaks out above 96 bucks. Starts to pull back a little bit, and we get in right around 98. I'm going to put my stop loss back below the downtrend line that we just broke out of. I'm willing to say, you know what? If this fails and we break back below that, all bets are off. JC's wrong. It's okay. That $2 a share that I'm willing to risk, if I'm buying the stock at 98 and putting a stop below 96, it's okay, because the potential reward based on my calculations is that the stock could go to 120. So if I'm willing to risk $2 per share to potentially make over 20, that's over a 10-to-1 ratio from a reward to risk standpoint. That's what we're looking for. We don't want to put ourselves in a situation where every dollar we're putting out at risk, we're only going to make $1 if we're right. For that, bet on sports or go to the blackjack table. We're here to manage risk responsibly and put ourselves in a position where if we're wrong, we're going to lose a little bit, but when we're right, we're going to make up for all of those losses and then some. That's the goal here.